So if you've ever watched personal finance content on the internet before, you would have heard the term DCA or dollar cost averaging thrown about everywhere, basically in the comment section and on the videos. Now the term dollar cost averaging refers to when someone, let's say they had a lump sum of £10,000, but instead of putting £10,000 into the market right now, they would decide to split that £10,000 up, let's say into 10 equal parts, and choose a defined period of time, let's say every month, that they want to spread out that £10,000. So instead of putting £10,000 into the market right now, every month they'll put in £1,000. And the idea is that because the market is so volatile, as you can see over any period of time, whether it's a day, week, second, month, whatever it is, there is so much volatility. And the idea of dollar cost averaging is to actually reduce the effects of volatility and smoothen out the process instead of putting just all of your money into one point in time. Now, for new investors, if you put all of your money into the stock market at one time, or at least the first amount that you're starting with, you can see over any time period, especially a month, you could be down by 6% quite easily, as you can see here with the FTSE All World. And that is quite a hard loss to stomach. And I do genuinely understand that it could be a bad thing to see on your portfolio. So the question remains, can dollar cost averaging actually reduce the effects of market downturns? In this video, we're going to explore that topic. This is as opposed to lump sum investing. As you can see right now, if I had, let's say £10,000, I would buy this fund here for £108.54, for example. But then again, the next day it could drop to £100 or whatever, and I could see a loss in my portfolio. So over the past 15 days, I've actually been doing an experiment where I invest £100 every single day into the Nasdaq 100. As you can see, over the past month, the Nasdaq 100 is down by 9.86%, which is a huge amount and it's nearing crash territory. So I thought this was the perfect time to show if my dollar cost averaging per day, which is quite excessive, I know, has actually reduced the impact of this quite rather large market downturn. If you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to use the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days and haven't received a free share, all you have to do is click the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, use my code JUBAIR and you should receive a free fractional share. Now, this is my Trading 212 stocks ISA, and if I scroll down, you can see here's a fund called the EQQQ £100 a day fund. Now, first things first, 15 days ago while the markets were open, if I had invested £1,500, how many shares would I have and what would my shares be worth now? All I have to do is scroll down into the history tab here, and you can see I first bought into these shares on the 13th of February and have been buying every day since then while the markets are open, so not on the weekends. So on the 13th of February, I purchased these shares for £42.74, as you can see here. So if I had invested £1,500 back then, today I would have had 35.1 shares. Now today, right now, the price is £38.62. Bear in mind, there are caveats to this experiment. For one, the stock market is open right now, so there will be fluctuation. Believe it or not, I am professionally actually a scientist. I have over 25 papers that I've published with my experiments in them. However, this isn't going to be the most scientific. Of course, our sample size is very low, only 15 days. And to do it on different time periods, you're going to get different results. Just thought I'd add that. But anyway, let's find out how much our shares would be worth today. Our shares right now would be worth £1,355.56. That means we would be at a loss of £144.44, or a loss of 9.63%, which is pretty high. Now, as you can see, I have been investing £100 every single day into this pie here. My net deposits is £1,500, so that's £100 every day for 15 days that the stock market has been open. Now, as we can see currently, the numbers have changed quite a bit and they are changing, but we are down by dollar cost averaging by 7.2%, or a loss of £108, but we would have been significantly worse off if we had just lump sum invested on the 13th of February. Now, of course, things like this do happen every now and then. There's always going to be a different reason as to why the market has gone through a downturn. Over the past month, like I said, we are actually basically down by nearly 10%, which is a huge downturn to be down by. And even though this is quite a large downturn, it is not atypical for the stock market. Now, as long-term investors, What we really care about is the future, not what has happened just over the past month. If we zoom out, we can see that this fund here, of course, over the past few years has indeed returned a very positive result. And although the downturn does seem significant right now, by zooming out, we can see there have been plenty of downturns before for various different reasons. And even though past performance is no indication for future performance, a well-diversified index such as the Nasdaq 100 or the FTSE All-World has in the past yielded good results over the long term. So realistically, we don't have to worry. And personally, in my opinion, I would still always lump sum invest rather than trying to manage my money by dollar cost averaging. This is because, again, as investors, we expect there to be growth in the future rather than, potentially right now. So no matter what time period you put your money in, as long as the underlying index actually goes up, it really doesn't matter. And as investors, we want to increase the chances of retiring with a higher amount by regularly investing. And by regularly investing, oftentimes we are buying at a lower price, and that can reduce our average buying price over the long term, rather than just looking at the stock market every day. However, that being said, I do look at the stock market every day. It is something that I really do enjoy and find entertainment from, but as long-term investors, the story still goes, time in the market is going to be probably better than trying to time the market. So make sure to check out some of my other videos, and I'll see you in the next video.